So what I want to cover today is just a quick snapshot of where the industry is at with after-tax investing, then get into why we're really here today, which is to talk about moving beyond your Australian equities after-tax investing approach. I'll give you 3 examples of the case for after-tax investing in other asset classes in the listed market space, and then finish with some concrete steps and how you would actually apply some of this thinking in practice. Let's start with where the industry is at, which I'll do fairly quickly. So I have used this diagram before without so many colours, just to talk about some of the players, some of the contributors in this space, and there's quite a few of them. But what I thought I would do today is just share with you my view on who the real catalysts are, who's actually pushing the industry down this road to an after-tax rather than a pre-tax investment focus, who's sort of in the middle, so some people are catalysts and some people aren't really, and who's really passive in this. And there are a couple of, I think, quite surprising observations. So you'll see that I think the real catalysts are the government and APRA, and as Chris mentioned just before, the reason they're catalysts is because they do believe that that is a better approach for members, and that's now written into the new stronger super rules. And of course we've seen certain specific after-tax solution providers that have been very active in this space in educating funds and getting out into the market. I think the mix that I've got there in yellow are super funds and investment managers who within which I've seen a range of responses. So you see some super funds that have been very early adopters, believers in the business case of after-tax and following that up with action. And then you see some funds that are kind of moving in that space because they feel that they have to do it without being particularly enthused. And then other funds that really, I think, consistent with that survey, have not made a start at all. And investment managers are exhibiting that same kind of range, so that you get some that see this as a bit of an opportunity to differentiate themselves and genuinely add some value. You get an awful lot of investment managers who are being dragged into this space without, in my opinion, really wanting to be here at all. And then I think there are, in red there, you've got a couple of players in the market who I don't think they really wanted to go there at all, but they get that from the media's perspective, there's a story in this and there's a need to cover it. From the custodian's perspective, they get that being the repository of all the tax data, which is an important part of most after-tax solutions, they need to actually get on board. So we are seeing most of the custodians now being able to offer support in the way they need to in this space. I think the other interesting thing now is if we look at the passive members of the industry, members obviously aren't even aware really of the issue, and I think that's because they expect that from an investment management perspective, we're already doing things with an after-tax focus because that is what members eat. But I think the asset consultants is an interesting one, and I know that I work for an asset consultant and I think we are the exception, but I actually think they've been very passive in this space and are firms that could do a lot more thought leadership and a lot more educating of the industry than they have done. So I don't think they've been catalysts at all in that space, and if there's any of them here, I'd be very happy to hear from them, perhaps in Q&A time a little later. So let's talk now about why you should be moving beyond Australian equities. And I realise that there's a third of the participants here that haven't got to Australian equities yet, but so looking a little bit further because some funds are there. In a nutshell, the opportunity set is beyond franking credits. It relates to different turnover profiles of the different strategies that you're in, as well as the different asset classes and the tax deferral, so growth versus yield profiles of each of those prospects. It relates to things like how cleverly you use your tax loss or DTA balances as tax shelters, existing tax shelters, for gains that you realise on capital rather than revenue account. it relates to any of your capital asset classes where you have the ability through the CGT discounting rules to qualify for a 1/3 reduction in the tax hit on that strategy. And also things like withholding tax drag and leakage, which is particularly of interest if you're a fund with a growing pension asset base. And of course we'll hear from Colwant later on the real opportunities out there to factor tax in a very sophisticated way into the decisions you make about cross-border investments and the jurisdictions and the structures that you can use and the different tax outcomes that you can get there. So the opportunity set is well beyond franking credits and well beyond Australian equities. But even if you're still working through all of that, the bottom line now is that this new stronger super legal and fiduciary obligation is a whole of fund after tax obligation. So it's not just your 30% Australian equities allocation or whatever you have in your my super offering or balanced account. It's actually an obligation that needs to apply on a whole of fund basis. So let's jump into some detail here, and this first example is based on different US equity styles. So this is a data set that's very long term. It's most of the data represents 1974 to 2010 average returns. The one there that might look a bit mysterious is the MOM-LC and MOM-SC. Those two are strategies used for the research paper, which are a mixture of large cap or small cap and value, just based on that momentum and value. So it's based on some of that research that many of you would have seen, that you can actually get a better outcome by diluting a pure momentum approach by adding a bit of a value bias. So that's the reason for having that in there. So what this data set is showing is that there are some quite interesting differences in tax characteristics between those different strategies. And none of that comes out from the pre-tax numbers. So just a couple of things that catch my eye, and this might be something that you work through at your own pace, because I'm sure you'll get a copy of these slides. One is simply that the after-tax return numbers, which are the second far right column, they're quite different from the pre-tax numbers. So just simply, it's a simple statement, the numbers that you work off in making your investment decisions and understanding your strategies, they're actually quite different if you actually look at them on an after-tax rather than a pre-tax basis. One of the other observations, and this is a bit of a recurrent theme in a lot of the research that I do and that I've seen other people do, is that when you rank strategies and managers within strategies on an after-tax basis, the rankings by and large don't change much. They only change at the margins. But even that's quite interesting where it does change in the margin. So, for example, here we can see on a pre-tax basis, we can see that proposition that you can get a better investment outcome by diluting your large cap momentum strategy by adding a value bias, that actually isn't supported on a pre-tax basis on the return data. But when you actually factor in the tax characteristics, you get that you actually get adding the value bias coming in ahead of the pure momentum large cap strategy. So you can see that sometimes those marginal differences do add meaningfully to your insights. One of the other ways that rankings have changed in this very long-term data is that on a pre-tax basis, the difference between having the Russell 1000 value strategy is versus a small cap strategy or just a mid cap strategy, you're fairly different between the two, but you actually come out about 18 basis points ahead on a small or mid cap basis on an after tax basis. So all of this is just a way of illustrating that you actually do add to your insights and you actually have more information to make better decision making by including some of this after tax analytics in your data set. Couple of other things that I'd point out before moving on. One is that the dividend tax rates and the tax on yield do change a lot because of the different tax characteristics, and even then, if you've got to think about your particular fund situation. So you may not care a lot about whether where you have small differences between something that's realised as yield or dividend amount versus CGT. This data set shows you the difference in after-tax sense, but if you then were to factor on something like the fact that you have a lot of carry-forward capital losses, so you actually aren't paying any tax on a return that you actually generate through growth rather than a different dividend yield, those differences become larger, and those differences would and should impact your decision making. The other thing, which is also a recurrent theme amongst the other research that I do and that I've seen, which comes out here, is that turnover is a very poor proxy of tax efficiency. So you'll see here that the bottom two strategies, the momentum strategies, are showing very high, so over 100% turnover. But you actually have to go much further, because this shows that they actually look quite good on both a pre-tax and an after-tax basis, and that's because the components of the turnover aren't too bad. There's a certain amount of long-term rather than short-term gains, and quite a lot of losses that have actually offset the tax on the short-term gains. So that's really just a reminder of something that I've seen time and time again, which is that if you're asking questions about turnover because you're wanting to get a sense of tax efficiency, that's not a bad place to start, but you really have to go much further than that, and it's quite dangerous to make decisions just based on very, very simple turnover questions. So let's look at case number 2. So this is a real example of a little bit of work that I did for one of our clients with a tax-exempt pool, and they had recently seeded just a passive mandate with an international equities manager that was 341.1 billion. And I just looked at the withholding tax on that based on sort of forecast yields of 2.4%. And what it turns out is that they have a yield, so expected dividend flow on that mandate about 8.1 million, calculated the withholding tax on that of about 1.2 million per annum. Now the issue with a tax-exempt pool of assets is that they don't actually get that withholding tax back. So that was a 36 basis point issue for them, which is a permanent leakage. That's not a small amount. And so we worked with them on ways to actually reduce or eliminate that 36 basis point leakage per annum. And there are a number of ways that you can do that, which we don't have time to go into today. But the point there is that just by thinking about that structure and that approach on an after-tax basis brings out a simple opportunity to significantly improve the international equity outcomes for this client. Okay, let's look at the third piece of work that we've done at Russell, and this relates to some multi-asset rebalancing. So if you think about rebalancing, the rebalancing process, it is innately tax inefficient in that you tend to be selling the growth assets, the assets that have rallied, and crystallising tax on that, and you're buying into the loss sectors. And as much as you'd like to crystallise a tax loss, acquiring assets on the loss side, that's actually not a taxable event. So there are some real areas of opportunity by thinking more cleverly about your rebalancing process. And some of the things that that I would throw into the mix based on work I've done, for example, considering some systematic long positions, so long relative to your SAA weights, so your targeted weights, around things like Australian equities that can give you the franking benefits, or even capital asset classes where you've got a big DTA shelter, and if you generate those extra gains on the physicals, you're not paying tax on those, and then countering that in an economic sense with an additional short on your rebal overlay exposure. So you've got your net economic exposure that you want, but you actually get some better tax. You get the portfolio overall working in a more tax efficient way. Some other ways that this can work is by considering in the process of rebalancing whether you have physicals that are coming up to a cum dividend season where franking applies, or even just any kind of capital asset where you've got a whole lot of assets perhaps that were transitioned, or a new mandate or manager that was seeded within the year, and those assets aren't qualifying for that 1/3 CGT discount, so there's an opportunity to use the rebalancing overlay to either defer the rebalance or give you that exposure another way, just until the clock ticks and you actually get that 1/3 tax reduction. Just one final example on this, and it's interesting because it applies to pooled funds where you think you can't do much in the after-tax space, is if you're looking as part of a rebalance that you need to redeem from pooled funds, but those pooled funds are cum distribution, so that you've got tax credits attached. Those tax credits aren't valued in the unit price, so if you redeem cum distribution rather than X, you just walk away from those tax credits. There's an opportunity to work with your rebalancing overlay manager again to delay the redemption until the units go X, and actually get the economic exposure earlier when you want it. So, what actually works for your fund will be quite particular to your circumstances, but I think the key message is that you can't even think about what might be over there, let alone work with a rebalancing overlay manager, if you don't have an after-tax mindset and you don't have the right parties and investment managers who are willing to think about things and work with you on an after-tax basis. So, final thing before I hand over to Cole Want is just some concrete steps. The first thing is that you really do have to make it matter to someone in your fund, and I say that I don't mean to make it sound like like I'm saying something obvious, but you can think about tax as part of your performance opportunity set, or you could easily put it in a box and say it's an operational thing, or it's a risk and compliance thing, and it's very important to be clear within your fund where it sits and who owns it. And if you don't have that clarity there, then you're not going to get the go forward that you need to genuinely have an after-tax investment approach. So do clarify who your owner is in the fund and try and get that ability to move forward in a genuine way. You also do need to become empowered and understand that to date, we haven't had a lot of information. We haven't asked our advisors, custodians, managers, etc. to give us a lot of data that's after tax rather than pre-tax focused. But you can get a lot of that reporting, you can ask for it. And Chris reminded me when I was putting this presentation together that some of the solution providers are actually very good at helping you run some initial analytics about what your results look like on an after-tax basis. And that's important because you don't know how much you care about the problem because you haven't measured yet. So it's a great place to start to understand how much you care about this as a problem or an opportunity, and then how much of a priority you want to give it to actually redress it and make it more efficient in an after-tax sense. You do need to find out what's available. So if you last really looked at the concept of after-tax investing back in 2007 when markets were rallying and people were starting to think about the huge tax hit on huge alpha, a lot has changed since then, and in my time specialising in this area even, which is 5 or 6 years, an awful lot has changed. So get up to speed with what's out there in terms of specialist advisors and solutions. And finally, make that strategic decision very early on about whether you're going to do the full thing and push it down as a top-down approach, or whether you're going to cherry pick and just start in certain key areas or asset classes where you think there's real bang for your buck. Thank you.
I've got 20 minutes to talk about quite a complex topic. I'm not going to do it justice. But what I can give you a flavour for is what's happening in a large institutional fund such as ours. I wanted to cover 4 things today. Number 1, why is this important in unlisted space and what the opportunity sets are. Number 2, how you go about doing it and what is it that you do to optimise after-tax returns for private assets. And thirdly, a case study of which illustrates the principles being applied to improve after-tax investment performance. I've focused on an international case study because I think the principles are best illustrated there, but it's equally applicable in a domestic context. And fourthly, talk to you about some emerging trends that I'm seeing in being in-house in a large institutional fund. I probably should mention, when I talk about private assets, I'm putting real estate, infrastructure, private equity in the same bucket, because often the tax issues that are relevant are similar across all those. Just focusing on the opportunity set. As I sort of said, I think there's a significant opportunity set here. To date, the focus has really been in the public sort of discussion space on listed markets. But in the unlisted markets, for what I see, there is just as a compelling opportunity set. And it's driven by a few factors. One is the large asset allocations. Typical asset allocation for a large institutional fund, 10% in real estate, 10% in infrastructure, and around 5% in private equity. That's like anywhere from 0 to 25% of your fund can be invested into these sorts of assets. There's huge allocation, significant amount of money in those, and my sense is that the appetite for these sorts of assets is growing. You're seeing increasingly global competition, like the Canadian funds coming to Australian assets because there's a desire to hold these sorts of assets. Number two is that these assets typically have significant tax transaction costs. So when you buy this, if you buy a port, if you buy a airport or a tunnel or whatever, or a hospital, there's got to be significant stamp duty costs up front, GST costs up front. Then there'll be costs associated with holding the asset. Typically there'll be GST leakage or land taxes. And then thirdly, on exit, when you're getting out of these assets, there'll be transaction costs at the end, typically in the form of either GST, there'll be another layer of stamp duty and capital gains tax. So all through the process is significant tax hits along the way, which is why it's important. The third thing is, that's why I think there's a significant opportunity, and is that people are increasingly going international. We're increasingly going international. As soon as you go international, the tax can make the difference between whether the deal makes economic sense or whether it doesn't make economic sense. Probably the fourth point is, I don't think all managers are doing this and looking after superannuation funds. I was a global head of tax for one of Australia's largest investment managers based in Sydney, and I won't mention names, but our interest in tax was very different to how we look at tax as the ultimate owners and ultimate payers. There's very, very different objectives that was sort of driving decisions at the fund manager level versus the decisions that are being the things that we need to think about at a super fund level. So I think there's a lot in this. Before you go down this path, and we're a long way down this path, I think there's a discussion that needs to be had at board levels, at investment committee levels, at audit and risk committee levels, and at senior management levels about what this is about. There is no debate. There is absolutely clarity that you've got to pay the tax that is legally due, right? So you can't move from that. But at the same time, I think what we're saying at QSuper is that there is impetus for us in looking after members' interests, that we are not leaving legitimate taxation benefits on the table. So if there are legitimate taxation benefits to be gained, then we should actively pursue those. As you know, it is the post-tax returns that we credit to our members' accounts. So what am I talking about in terms of legitimate taxation benefits? Some of the obvious ones in the Australian market, you get a capital gains tax discount of 33 1/3% if you hold an asset for 12 months. We get tax depreciation on shopping centres, infrastructure assets, and that can be very valuable. We get franking credits on equities. We get tax credits for foreign investments when we pay foreign taxes. Those are some of the Australian examples. But in foreign markets, for example, if you invest into the UK market, foreigners don't have to pay capital gains tax in the UK markets. Similar principle in Singapore. If you go buy a Singapore property, there's no capital gains tax regime. Similar principle in New Zealand. So those countries have valid tax concessions and taxation benefits that are available for investors, and we look to optimise those benefits. Our approach in terms of the QSuper's approach in terms of striking the right balance and taxation management. As I already alluded to, we've engaged our board. We have a board-approved corporate tax governance policy which sets the framework in terms of tax risk appetite and what things are acceptable and what things are not acceptable. We can only adopt tax positions that are consistent with the tax risk framework that the board has endorsed. The risk framework tells us about the level of sign-off and level of proving up of the positions that we need to do. So, for example, as the potential tax amounts get larger and larger, the sign-off gets bigger and bigger. Ultimately, at one end, we can do internal sign-offs. At the other end, we need to engage with tax authorities. And part of my job is to engage with tax authorities. I engage with the tax office, with the IRS, or any other foreign tax authorities in working out our positions. But within that framework, within that parameters that the board has given us, we are allowed to actively pursue tax planning opportunities that maximise returns for our members. However, we always ensure that when we're pursuing those opportunities, that the opportunities that we pursue are sustainable, they're long-term advantages that we can get for our members. We're generally not interested in one-off things. I also have a governance reporting framework. For example, I regularly engage with the investment committee. I regularly engage with our audit and risk committees in relation to our tax positions that we've adopted. Probably the other thing that's peculiar about QSuper is that the senior management at QSuper have thought that tax was important and have invested significant time and resources in building the tax function. I have a reasonably large team in terms of tax. I think if I look at it in terms of the investment space alone, I have 4 members of my team that are focused purely on looking at the tax situation with our investments. The team is very integrated with the investments. For example, when we do investment transactions in unlisted markets, it's typically the investments team and the tax team that'll work together to work out our post-tax IR numbers. And then once we've computed those numbers, then the decision is made as to whether we go ahead or don't go ahead. Then we help out with transaction execution and management, and we also look after ongoing taxation management associated with our investments. I think these rates are fairly well understood. Maybe some things that are not well understood is the rates that are applicable to non-arm's length income, and so that's worth probably talking about for a bit. What non-arm's length income is, and it's generally not a problem in sort of at the bigger end of town, the institutional end of town. But and it's more of a problem at the smaller end of town, is it's a principle that's in the legislation which sort of stops you pumping up your superannuation fund with excess returns, if you like, or non-arm's length returns. Because of the CIS regulation, the higher level of a regulation that occurs at the institutional end of the market, it's typically not a problem, but it's something that you do have to pay attention to in private assets, that the Commissioner could never take a position that a level of return being generated from investment assets is non-arm's length in nature. The zero tax rate for pension assets is interesting. We're really starting to think about pension capital very differently to accumulation capital. I'll come back to that a little bit later on. The other point there is foreign taxes. As we invest into foreign taxes, the foreign countries will want to tax you on those investments. So the way that, without boring you through the detail, the way that globally countries allocate taxing rights is on 2 principles. It's on residency and source. So most people in this room will likely be tax residents of Australia. As tax residents of Australia, you are taxable on your global or worldwide income, irrespective of where it sits. Doesn't matter if it's sitting in Spain or Germany or UK or US, you're prima facie taxable on that. But when you go into foreign markets as a resident of Australia, you're taxable on the income that is sourced, or the return that is sourced in that country. So if we invest into the US market, the US will also try and tax that return. So you have this conundrum occurring now, because Australia will want to tax you as a resident, Australia will want to tax QSuper as a resident taxpayer, but the US will also want to tax the investment, and we've got a double tax situation to manage. And that's a tricky thing that we look to manage all consistently. The other point there is that about credits. You know, people always say to me, if we've got to pay foreign tax, don't we get a credit for it, so what's the big problem? Well, the Australian tax legislation has got a bit to say about that. You don't automatically get a credit just because you paid foreign tax. Right? That's a falsity. If anyone tells you that otherwise, it's not true. Trust me. That's number one. Number two is that increasingly, I think this is going to be a bigger and a bigger issue in looking 5 years, 10 years out. Increasingly, there are caps being imposed in the Australian tax filing positions on the amount of credits you can claim. So under the Australian tax legislation, you have something called what's called a foreign income tax offset cap, right? That cap is sort of set up in a way to limit the amount of credits that you can claim. And so as your foreign investments grow and your foreign tax increases, you're going to run into this horrible situation. You've got too much tax being paid overseas. It doesn't rebate your Australian system, as your returns will go down. Unless it's carefully managed. If you look at here just as an example of how big the foreign taxes can be, if you look at the US market, which I think is right down the bottom, so the US corporate tax is 35%. Generally, it's very hard to get the 15% rate. It's generally 35%. So if you're deriving business income or if you're investing in infrastructure assets or real estate assets, prima facie 35% of your return can be gone in corporate taxes. There are also state taxes. Most US states levy state taxes. And then there's another layer of taxes. When you repatriate that cash flow that's being generated from those assets back to Australia, the US will try and collect another level of cash flow, which is what's called withholding taxes. And those withholding taxes differ depending on the legal nature of the cash flow, whether it's interest, dividend, royalties, etc. I just want to move on to how we go about doing this. And sort of the approaches to increasing after-tax investment performance in equities. Probably fair to say that if you're a fund, if you're a superannuation fund, you know, some of this stuff might be occurring at the manager level. But some of it, if the way that you invest is through fund-to-fund structures, or a lot of your investment decisions are outsourced to the manager, then the manager should be doing this, what I'm going to talk about. But if you do direct investing like we do, a lot of this stuff is done in-house or conjunction with our managers. My own personal experience is that the managers can be doing more in this space to look after post-tax returns. For our members. I think certainly over the last maybe 5 to 10 years, things have improved substantially compared to where they used to be, but there's still more to go. As I alluded to before, when private asset transactions come into our place, they get evaluated. The tax team's involved in the decision making on the go forward decision on those assets or not go forward decision. We look at the total tax impact across acquiring, holding, and disposing assets. We do calculate the post-tax IR numbers, and only on base those numbers, then we go ahead or don't go ahead. I alluded to before about when you're investing into international markets, the double tax problem. That is a real significant issue, and why structuring solutions are needed to manage that issue. So how do you go about doing these sorts of things? There's probably sort of a few tools of the trade, if you like. First thing is looking at the way you undertake these investments. So each one of us in this room can structure our own affairs any which way we like. And the Australian tax legislation provides choice. We can carry on our businesses through company structures, we can carry on our business through unit trust structures, we can set up discretionary trusts, and the taxation consequences differ across all of those. So just like in the Australian markets, when you go into the US markets, the way we invest into the US markets is very, very different. There's structures such as limited liability companies, limited liability corporations, C corporations, business trusts, And then there's companies that behave like partnerships, what we call flow-through entities or disregarded entities for US tax purposes. So a lot of my job and my team's job is look at the different vehicles in which we can invest and look at what is optimal for us, having regard to what we're going to invest in. It is really important to understand the choices. It's also fair to say that, and this has occurred a few times, that typically when a foreign manager brings you an investment and a vehicle to invest in, that will not necessarily be the optimal vehicle having regard to the Australian taxation consequences that are applicable to Australian taxpayers, number one. Number two, what I would say is that having worked at a large Australian fund manager, when you're structuring the affairs or structuring vehicles for a fund manager, you often have competing objectives of different clients. So you might have, global sovereign wealth funds going into an asset. You might have Australian taxable clients, Australian tax clients, taxable and non-taxable pension fund clients, and each one of them will have slightly different drivers, and trying to make them all work can be a challenge. So what that means is that when you're looking at foreign managers' vehicles, you just need to be attuned to that they may not work for you. The other thing there is that that yield is often taxed very differently to capital growth. So in investment market, we talk about yield and capital growth. In tax, we talk about capital gains and yield gets broken up into different things such as dividend income, interest income, and rent, etc. And what's interesting, if you look at sort of the global tax landscape, is that the tax rates applicable to different components of yield are different, right? So interest flows typically, and this is designed largely to create deep liquid financial markets and reduce tax drag. So the tax that's applicable to interest flows is generally either 0 or 10%. The tax that is applicable to dividend flows is generally around 15%, can be high as 30%, and in uncommon situations can be 0%. And rent typically tends to be a higher tax on that. So one of the things that tax people look at is what's the legal form of the yield that we're deriving, and what is the best way to migrate that yield back to Australia? Is it to migrate it in the legal form as a rental stream, or is it better to migrate it back as an interest stream? And we can talk about that, show you a bit of that in an example that I've got a little bit later on. Capital growth. Capital growth for listed markets is taxed very differently to unlisted markets. If you have a BHP, if you have a share on a US stock exchange, you're not going to pay any tax on that if you buy and sell, US tax on that if you buy and sell that share. But if you've got a share in a US private asset held through a corporate structure, you will pay US CGT or FIRPTA, likely pay US CGT or FIRPTA on that. So there's a big difference between listed and unlisted. So my general point there is understanding the differences on the cash flows and the tax on the different types of cash flows is a key aspect. The other thing we do, and I've alluded to this before, is we optimise the legitimate tax concessions that are available. In the Australian space, as we said, the 33 sort of discount that's there. But in the US markets, one of the biggest tax concessions that the US offers, and if you're an investor in the US infrastructure and real estate, is US tax depreciation. So unlike our system where tax depreciation is capped by historical construction costs, the US doesn't work like that. The US works on a model where market value of an asset is allocated. So if you buy an asset and the market value's gone up, the next guy that comes and buys the asset gets to reset their tax depreciation base upwards depending on what they paid for the asset. So it's a very, very different thing to what occurs in Australia, and a legitimate concession that's available in the US market, and the one that we look to optimise. So there's some of the things that we do on the positive side. The other things that we avoid is the multiple taxation of returns. As I said, that can occur because the way that globally countries allocate taxing rights. The non-creditable taxes, as we're saying that if you've got to pay foreign taxes, one of the things that we do is try and ensure that we pay the tax in the right form. So, that gives rise to a credit in Australia, because if you do it in the right form, you're generally neutral. It's either you pay it to the US tax authorities or the Australian tax authorities. But if you don't pay it in a creditable form, there can be double hits. The third aspect is what I call accrual tax liability. So a lot of tax principles or tax legislation can have the effect of taxing an investor ahead of cash flow. So you've got to be wary of those. You can't do this alone. Broad tax advisory networks are critical. So one of the things that, over the last 10, 15 years that I've been really tried to build up is my tax network in the US market, in the European markets. So I'm aware and kept real-time informed about what's happening in those markets and how some developments might affect our investments. Ongoing robust compliance is a given. There's no point building the ship and not looking after it. So I just want to sort of quickly run through an example. This is a real life example that I saw in some of my earlier days. You've got and I've just put Q Super at the top, but it was actually another fund that was looking to invest into this. It was a real estate asset held under a US company. And I'll just give you an example of how the tax kind of worked in this. So let's say that the investment generated $100. You would have paid US corporate tax of 35% at the company level, and that goes out to the US tax authorities, and then a further dividend withholding tax, which in my example is I've used 15%, but can be as high as 30% as the cash leaves the US and comes back to Australia. So your net, the investment did not make sense on a post-tax IRR basis for the investor. So how could we improve that situation? We improved that situation by employing these sorts of techniques. We look to set up the right vehicle. In this example, we set up what's called a US Real Estate Investment Trust, which has the feature that it gets a tax deduction in the US on the income that's generated in that entity if it actually pays out on a real-time basis a dividend from the underlying cash flow. So what it does is it reduces dual layer of tax into one layer of tax. And so there's no corporate tax in that entity. The only taxes are withholding taxes. The taxes are in the right form that we get credits for those taxes in Australia.
We're pretty tight on time, Colin.
Yeah. Okay. All right, so just running quickly sort of on the home run, some of the emerging issues that we're thinking about pension capital. I don't know if we're unique in this space, but certainly 20% of our fund is in pension mode. So we're starting to think about how do we do things differently for pension capital versus accumulation capital. There's an ongoing challenge with complexity and benefit trade-offs, so that some of this stuff does lead to complexity, but there are benefits. What we found is that generally the benefits outweigh the complexity. There are global tax developments happening all the time. The tax scene is changing, and it's really important to stay in front of that. There's something called BEPS you might have heard of, which is base erosion and profit shifting, which is about Google coming into Australia, or Google not paying enough tax, or Starbucks not paying enough tax in the US, or Apple not paying enough tax back in the US. I think it's really important to separate and isolate the relevance or irrelevance of that sort of stuff. My feeling is that that's not really about pension capital, and in fact pension capital is very, very different and taxed differently, and is often invited into countries. So if I look at the US, at the same time the US is a signatory to this BEPS proposals, Obama's trying to push ahead with a FERPTA proposal because he wants to get foreign pension capital invested into US infrastructure and real estate assets. So it's a different thing. So in summing up, I think tax can make a big difference to after-tax investment performance on unlisted assets. I think getting the balance right and having the discussion is really important in the senior management chain. And certainly for my part, I would advocate taking an active approach to tax management, having your governance framework, integrating your tax capability and building your tax capability, and having them meshed with your investment teams to deliver solutions.